sky.
We'll go here in 3, 2, 1. Welcome back to another episode of Gimme Some Truth International. Dame la verdad, dites-moi la vérité. I was thinking, this morning as I was walking the dog that I should figure out how you say that in German from Martha. We should get the German on there as well. So very excited today to have kind of a different podcast than just the three of us here in the booth. We're excited to be joined by Leonardo Da Costa from First Trust Portfolios in London. Leonardo, as I mentioned, goes by Len, so that's what we'll probably call him today. He's based in the UK and heads the global rates and exchange rates, FX is what we call it here, team in London. He also sits on the First Trust Fixed Income Investment Committee and manages the global focused multi-asset model portfolios together with the team there in London. So, Len, welcome. Thank you so much for joining us today. How's everything over there?
It's all right. I mean, it's a winter's day here in the UK. We're soon going to lose the sun, but at least there's been no rain today.
Okay,
so
that's a good day.
Yeah, you're not like here in Madison where we're lining up to golf again next week. We're looking at highs in Fahrenheit in the 60s. I guess what is that? Low 20s, high teens in Celsius, somewhere in there.
Like that,
yeah. So not signing up for golf quite yet. So anyway, really thanks again for joining us today. We'll kind of get into the conversation here. Given your expertise, we're going to talk a little bit about the context for what we've seen in international markets, and really one of the big drivers, I think, Sil, has been the U.S. dollar, and so to kind of provide us, I think, a little bit of background on that topic. Sil, you had some questions.
I think it's a great opportunity to have just a good open macro discussion, really, and hear your thoughts and feedback. And I feel we can't have a macro discussion nowadays without talking about what I feel is the most important factor affecting the global economy, and that's the behavior of central banks around the world and their policies and how they affect currencies and markets. And so we'd love for you to kind of take us on a world tour of what you're seeing on the central bank policy front, and maybe we can kind of start at home, so to speak, and I mean at home for us, not for you. Start in the U.S. In terms of I think the current kind of interest rate environment and Fed policy in the U.S. is kind of interesting because I feel like we started the year with market expectations for rate cuts that I feel were very, very aggressive. I mean, I remember back in December, we were looking at market implied odds of, rate cuts for 2024 showing, a very meaningful possibility of something like 7 rate cuts, which sounded crazy. Probably, sound even crazier now. And I think we've been kind of brought back to earth a little bit here in terms of what we can truly expect going forward from the Fed. But I'm just curious as to what your thoughts were on where the Fed is currently positioned and what your expectations are going forward.
So absolutely, I think we lie on a similar page, really. We just really did see in the last quarter of last year how the market started pricing in rate cuts, and it just continued right into year end. And as you say, it got quite extended, looking for 6 or 7 cuts, and that's pulled back now. I think it's around 3.5. So the first 2 meetings of this, or the March meeting and the May meeting, the cuts have been priced in, and there's still one in maybe for June, which probably seems a bit more realistic. And that's probably maybe not unsurprising. Markets kind of running away with themselves. And then given that the data that we've had as well coming out, showing that inflation is maybe a bit more sticky, kind of really, really forcing that move. And that's through last year. our investment committee had a similar view in terms of that they thought inflation was going to remain sticky, but it made sense in the portfolios to remove some of the short bias on duration that we had relative to the relevant benchmarks. And so we began quite early last year feathering in a bit more duration exposure to take us a lot more flat versus the benchmark indices. And that's kind of our view, is that we really think we have seen the peak in terminal rates, or at least terminal rates priced in. There's obviously still the risk that if we do see a re-acceleration in inflation, that the Fed might look to do additional rate cuts. That'll be a real shock and surprise to markets if it does happen. But the view is that you're not looking at another, even if that does happen, another 200 or 300 basis points in hikes in the worst case scenario, whereas you potentially would see a rate cutting cycle starting somewhere in the second to third quarter and moving forward from then. So it's almost this outlook that but the Fed is done and they're going to look to start cutting rates. When is the question, and how aggressive? And I think that's really going to be data dependent. I think you've seen it with the data that's come out and how that's impacted the pricing. So I don't think you have any special insights on that. I just think, on the balance of probabilities, is that the Fed fund rates are going lower, and really it's a timing question rather than whether they're going to restart a hiking cycle or something similar.
So, kind of using the Fed as kind of the baseline, how do, the views of your next door neighbor there, the Bank of England, the European Central Bank, other central banks around the world, how do those line up with where the Fed sees things? Are they marching in lockstep, or are we going to see, slower rate cuts elsewhere, hikes possibly? What's the feeling out there elsewhere in the world?
Yeah, I mean, that's a good question. So Western Europe is pretty similar. I think they lagged a bit in terms of the Fed hiking cycle. So, if you recall, when the Fed did start really hiking aggressively, because they almost fell behind the curve, right? They were calling inflation transitory for a very long time. And then in that period, early 22, that's when we saw the rate hikes really starting. And it took a bit longer for the Bank of England and the ECB to really start getting their act together as well. And so they kind of followed the Fed. One interesting thing to note from that period was just how fixed income volatility increased. So I'm not sure if you guys are familiar with the MOVE index. So it's the equivalent of the VIX index for equities. Let's look at implied volatilities on fixed income markets. And it really spiked around that period, and it's remained elevated ever since. And I think part of that was driven by this, is the Fed and a lot of these Western central banks getting behind the curve in that period. But they've really they followed movements in the Fed, and what we're seeing now is the ECB they had rate cuts priced in for earlier this year, but those have also been pushed further out. So that's also looking more likely in the second half, maybe in the June meeting for the ECB, and then potentially even later for the Bank of England. So in August is where the market's looking at right now. But really almost similar in lockstep. I think the big differences are that in the UK, we're here now in a technical recession. We've had 2 quarters of negative GDP growth. Economic growth has been quite soft. Inflation has still been a bit more sticky than the Bank of England would like. And so, the debate is still out there in terms of how quickly and how aggressive they do move lower. But it's a similar story that we really think that terminal rates are priced in these markets, and the next move is to look at where and when to cut. The big differences when you look at globally is obviously China stands out, where they are still in an easing cycle. So they did another 10 basis points on their medium-term financing rate and on their 5-year prime loan rate, which really impacts the mortgages. Obviously, they're trying to stimulate the residential sector there. And then in Japan, which is really counter, is that we're looking for their first hike in early this year. So, quite a mixed bag there, which obviously in terms of global markets adds a bit more divergence. The other interesting one, and this was an area of focus of mine. I spent a lot of time within emerging markets, is just how surprisingly emerging markets have actually led in this last monetary policy cycle. So one of the first few central banks to start hiking rates, mainly because they never had the luxury of calling inflation transitory, was countries like Brazil, where they already hiked quite early on, and then they've already started their cutting cycle. But because inflation has fallen really precipitously, there's a number of reasons for that. They never really had the same stimulus, the same money supply impulse that we saw through COVID from a lot of these developed markets. And so if you look at a country like Brazil, where overnight rates are 11.25%, and inflation is down at 4.5%. So it's likely that they will continue easing, particularly in Brazil. Colombia started as well, and we're looking at Mexico potentially starting rate cuts at some point early this year as well. So a bit of a mixed bag there, really. But definitely for Western Europe, they tend to be following the similar playbook to the Fed.
One of the interesting things, of course, about Brazil is that inflation being under control at 4.5%, whereas we were all freaking out when inflation hit 4.5% here in the United States. And I think it's why thinking about the context of what's going on in the U.S. versus the rest of the world is important. And obviously, one of the ways that affects our clients is in terms of the U.S. dollar. And so I know you had some more specific questions on, kind of the future of the U.S. dollar. Obviously, the fact that the U.S. started raising rates earlier than the rest of Europe had an effect on exchange rates. But what?
Yeah, I think I think rate differentials really between the U.S. and other parts of the world, that's been part of the U.S. dollar strength story at different points in time over the last few years. So I was curious, when you look at the landscape of central bank policies around the world, how do you feel about the dollar in general? I mean, I still think we're in this era of the strong dollar. I think historically this is still an environment where the dollar is king and is relatively strong. At the same time, I think we saw highs, for the dollar at the at the very end of 2022, and it's actually trading
like September 2022, right?
Yeah, and it's actually trading lower since against a number of international currencies, and certainly if you look at the DXY index, for example, it seems to be trending lower. So I was just curious in terms of your expectations going forward for how you see the strength of the dollar versus other currencies, and any potential changes in the role of the dollar in the global economy as a whole.
Yeah, so that's a very important question when it comes to international, right? Because it has quite a sizable impact on portfolios. When you're investing overseas, you're obviously taking non-dollar risk. Really, with the US dollar, so you're right. The dollar index peaked in September 22, and we saw a move lower, and then year to date we've seen it move a bit higher, and that's had quite a big impact on some of these global portfolios. So since September 22, we've seen a lot of international markets doing really well, especially when they're priced in US dollars. When you look at the valuation metrics for the US dollar, so we look at something called purchasing power parity, which is essentially a Big Mac index, but rather than just based on a Big Mac, it's based on your CPI basket of goods. So it's looking at relative.
Just so you know, Len, the Big Mac index is Keith's favorite topic.
Yeah, I love the Big Mac index. Early on, in fact, brought in a Big Mac, and we did a podcast where I ate it on the air. So be thankful that you missed that, I would say. But for listeners who may not be familiar, the Big Mac index is a purchasing power parity index, right? Put together by the economists, basically giving the price in local dollars and then kind of the U.S. dollar equivalent. And in theory, if everything is right, the prices should be pretty close to equal. That is to say, if you buy a U.S. Big Mac in the equivalent in euros, it should cost you, give or take, €5, and in the U.S. it should also cost you, or in London or in Paris, we'll say, it should also cost you €5 more or less. That's kind of the underlying influence or idea of it. Sorry, yeah, continue. Sorry, I got all excited.
I've missed out that I didn't join the podcast where you were eating Big Macs. You're right. So that's the concept. It's almost linked to the law of one price, that especially tradable goods should have trade at the same price across borders, when you adjust for the exchange rate, because essentially, let's say a bar of steel in one country should be the same cost as a bar of steel in another country if you X out the transport costs. So the World Bank publishes this measure, purchasing power parity, based on the CPI basket. So rather than just looking at the Big Mac in each country, it's looking at what's priced into the CPI baskets. And using that measure, the dollar is really expensive across or versus most of the G10 currencies, apart from maybe the Swiss franc, and then across most of the EM countries as well. And then also another measure that we look at is the real effect, or the real trade weighted index of the US dollar. So it's a series that the Fed puts together. So rather than looking at the US dollar just versus the euro, and what an interesting point is, you mentioned the DXY index. So that's very heavily weighted towards the euro and to sterling. It's about, in that basket, it's about 50%, I think, to the euro, and then in the sterling. So there's a very strong euro dollar driver of the DXY index, whereas the trade weighted basket is weighted by the relative trade partners of the US, which will move around over time as those trade partners' weights change. But it's probably a bit more relevant when you're looking at something like the dollar with regards to trade flows. And then it's also, when we say real, it's adjusted for relative inflation rate differentials across economies. So when the Fed calculates this measure, it goes back to 60s or 70s. And if you pull that up, really, the dollar's had three large peaks, shall we say, in its valuation. And the first was back in 1987, which was when we had the Plaza Accord, when global central banks acted in concert to try and weaken the dollar because it was so strong and it was impacting global trade to such a degree. We got to, in September 22, we got to about 10% shy of that level. So, the Dixie, the dollar index, excuse my shortening the acronym,
Yeah.
but it's rallied about 30% from its low over the last 10 years. And that's really been a drag on any US investors' portfolio has been invested overseas. So we had that peak in 1997, just getting back to that. And then we had another peak around the dot-com bubble. And we got ahead of that, higher than that peak, and we're probably currently around there right now. And yeah, right now we're at that similar level. And I guess the arguments I'm trying to make is that if you look at something like the trade weighted dollar, we are towards the peak of the dollar value. So yes, we've been in a period of a very strong dollar. And it's you could argue maybe it's quite difficult to see how that would reverse relatively quickly, but we are trading towards the top end of the range that we've seen. And that's what kind of gives me comfort when I'm looking internationally. It's like, okay, yes, let's say we could have another move higher in the dollar, 5-10%, but it's already quite stretched on a lot of the valuation metrics. And so really, when you're looking at opportunities, even if the dollar stays flat, so it's quite strong right now, but if that exchange rate stays flat where it is, and you're still seeing interesting opportunities internationally, you essentially can still get those opportunities and benefit if the dollar pulls back. It's a bit almost asymmetric. I think there's a lot more downside risk for the dollar than there is upside, just given the level where it is.
So you brought up the kind of peak in September of 2022, and Stan and Sil and I, common sort of source of conversation is sort of frustrations about investing internationally. 2022 being a perfect example, when things are priced in local currency terms, they outperformed the U.S. market in most cases in 2022. But, U.S., investors who invest via U.S. dollar accounts saw that kind of effaced by, the kind of strengthening dollar during that year when you reprice it into USD. And I think, Stan, you had brought up kind of the point that in talking to investors, there's a certain amount of frustration around this.
Yeah, I mean, and it's funny, Lynn. Thanks for joining us again. By the way, that you mentioned the late '90s because there seem to be a few things in the marketplace that feel a little late '90s right now, and one of them would be that and again, I think currency weighs factors in here, but U.S. large cap stocks have outperformed every asset class over the last 10 years, and specifically have been the top performing asset class in 3 of the last 5 years. Last year, 21 and 19, I believe, right? So it's like every other year, the U.S. large cap asset class on the Callan table has been up top, which feels very similar to the late '90s, does it not?
It does, yes. So you've had this...
and then, but we remember how maybe you could remind some people like how that unfolded for the dollar and for foreign stocks versus U.S. stocks after that 5-year period of dominance.
Yeah, no, that's...
Stan's playing Guess What's in My Pocket here.
It's not a quiz show. It's not a game show. But I'm wondering if, like, you see, if you see the pattern here, which is something that we've actually discussed in another recent podcast. Oddly enough.
Yeah, no, so absolutely, there are some similarities there, and when you see it was really. You remember that saying, Tina saying that there is no alternative to U.S. equities. It just was the trade, right? And I think that was, as you were going through the early 2000s up into the peak, that was the same case. I wasn't investing around there, and then I would have been finishing my studies. But that was a period where you definitely, it was the game in town. Right, and once that changed, that's when you saw a big reversal in the US dollar. There is a bit of nuance there, which is just a bit to be careful, is that the US dollar does perform well in really disorderly sell-offs and turmoil, right? So actually in the initial phase of the dot-com bubble bust, the dollar actually did do really well. And this is that whole theory of the dollar smile. So, the dollar tends to do well when U.S. economic growth is really great and U.S. equities are doing well because capital floods into the U.S. And then on the other side, it also does really well in times of real market stress because capital flows flood back into the U.S. because it's a safe haven currency. And it's really the benign environments in between where you would see the opportunity for international to perform well. So, that aside, unless you see a market collapse, similar to, a really rapid market collapse similar to the dot-com boom, we think the dollar would still hold up really well in that environment. But in that period of 2001, the dollar was already at a high, and it maybe did another 5-10% in that environment. So it maintained that strong value, and then it reversed course. So that's why I wouldn't exactly link it to A equals B, because there is this factor that the dollar performs well in stress environments.
Right. Well, and I think that may have also, if we look at the, kind of value of the dollar in the late 2010s, everything kind of got thrown off by the flight to safety during COVID. You saw just the rapid spike in bonds, all of that. And that kind of shifted things. One thing that, relatively speaking, that's been kind of shifting the conversation, kind of big picture, is the U.S. market and it's not even just U.S. large caps. It's about 6 or 7 U.S. large cap, right? The Magnificent Seven, stocks, so on and so forth, that have really driven these kind of outsized gains in the U.S. market. And so, one of the things that comes up is frequently when you look elsewhere in the world, people don't think of innovation elsewhere in the world. And one of the things Sil and I were talking about earlier, and Stan as well, was, things like AI may actually be a boon to emerging markets. And so, we're kind of curious to hear, what sources of these similar technology might you see elsewhere in the world, or how might, AI and so on help.
Are there particular countries, for example, in where you see government policy, tax policy, whatever, creating an incubating environment where we see, really interesting startup pre-public companies where there might be, innovation, be it in science or technology? Where do you see the potential for outsized growth to emerge from a corporate culture outside of Silicon Valley or Washington?
Who's finally going to compete with the
who's
U.S.?
Finally who's finally going to keep people, keep companies from moving to the U.S.? These younger new ideas.
That's a very good point. I do like sometimes being a bit controversial and pushing back a bit on that notion, because even if you look at Europe, there has been a lot of innovative companies. You just need to look for them. And so, one of the largest stocks in the Euro Stocks index is ASML.
ASML, correct.
Right, and it's one key example. So I wouldn't say that there's as many, but if you look at the returns of the Euro Stocks 50 index last year, it outperformed the S&P 500. Both, I think, in dollar terms and in euro terms, right? And I picked that index carefully as the Euro Stocks 50 because it's a lot more concentrated, but it's really on the levels of concentration of the US, and it's got a lot more less of a sector differential with the US. So was more financials, more consumer discretionary, more IT, less industrials, right? And so I think in certain of these sectors, even in the UK, the IT sector within the UK, it only makes up less than 1% of the FTSE 100 index. But its returns last year, that sub 1% allocation was about 36%. So we need to control for sector makeup and concentration as well. And when we do that, there are some interesting opportunities. The one that I think, though, becomes quite standout for me, however, along the lines of what you were talking about, is really India stands out as a place where you can see innovation being developed and the potential for it to run exponentially. There's a number of things that are coming or aligning in the Indian market, which make it a very interesting marketplace. It is relatively expensive if we look at the relative PEs, but not more so than something like Japan or the S&P 500. And its economy is growing at the last quarter release was 8.4%, GDP growth. And so you've got that underlying economic growth, and so that's obviously enables these high PE ratios. But one of the what's really driving innovation there is the digital infrastructure that they've put in place in India is quite incredible. We know that they surpassed China as the world's most populous country, and they're going to go through elections in April, May of this year, and they're going to be collecting votes from, I think it's 900 million people. And just having that large population, they obviously need systems to deal with that. And so a number of years ago, I think it was like 2016, I'm not going to quote the date because I don't know exactly, but it's called the Aadhaar system, where they basically got all citizens, or 1.3 billion people's identity information essentially online. And they've made parts of that available to public companies. So in order to open a bank account, you can use your Aadhaar system. They've also linked to that a payment system where citizens can make payments, instant cash payments through the system. And so they've got a really advanced digital infrastructure in place, and that just provides an environment for innovation, right? Especially in the IT realm and IT sector. And we've seen that develop in India. They briefly became the world's 4th largest stock market, so overtaking Hong Kong. So it's the US, China, Japan, and India. And that's quite an incredible feat for a country where GDP per capita is still somewhere sub $3,000. So that's one area where I think there definitely is a lot of potential.
That's amazing. I just was reading an article yesterday evening about, obviously India has been incredibly successful as an incubator of startup companies, but they were pointing out in the article that 2 of the most successful young public companies in the country, I think one was Paytm and the other one was an online education provider. They were both trading at 5% of their peak height because the regulators had come in and found irregularities in the accounting and reporting of financials, and I guess that's one reason why. Well, one reason why you want to play, hot markets like India in a diversified manner if possible, right? Because you're going to have, your euphorias are always going to produce some crazy valuations, right? But it also is just the kind of the cautionary tale that growth is one thing, but like investable growth requires a certain degree of what we would call transparency and rule of law, right?
Yeah, well, and I think so. We have lots more,
which would lead me to China.
Well, and I was going to say, we have lots more questions for you, but we want to be respectful of your time. So we'll probably, hopefully, have you on again soon to talk maybe about China and Japan, and what you mentioned about India brings up a theme close to all of our hearts of GDPR and how that might affect AI growth and those sorts of things. So we really appreciate your time, Len, and thanks for coming on, and hopefully we can have you on again soon to maybe touch on Japan and China and transparency and the craziness of UK politics.
Yeah, we didn't get a chance to delve into which country, ours or yours, has the most polarized political system, political friction right now.
Oh well, yeah. That we need a whole new podcast to go into that.
Yeah. I was going to say that's you guys can weigh in on that one. I think that one's above my pay grade, the comparative political analysis. So really appreciate your time today. Thanks for joining us, and get home. Hopefully you can get home here in a little bit of fading daylight yet in London, that it's not totally pitch black for you.
Yes, no, I appreciate it. It's been great to be on. Thank you for having me.
Thank you.
Sounds good.
Cheers, Lynn. Thanks so much.
Yep.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Viewers are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.
You gotta leave your money behind you. Raise your hand to the sky. Ask the masses for silence.